Welcome to Talk Shop, a commercial real estate finance podcast sponsored by Clear Market. Each episode, we'll bring you real conversations with industry professionals and talk about how deals are getting capitalized with bridge, construction, and equity financing. Our guest today is Eli, the founder of Base Equities. It's a small balance preferred equity capital provider based in Los Angeles. Prior to starting Base Equities, Eli was a principal at LaSalle Debt Investors, where he was responsible for loan origination, underwriting, and asset management of over $1 billion in asset value. Eli holds a BA in Sustainable Planning and Real Estate Development from the University of Southern California. Eli, thanks for coming on the show. It's a pleasure to have you.
Of course, thanks for having me.
Before we get started and get into Base, which I'm really excited to do, would love to start with your background, where you're from, how'd you get into real estate, and tell us your story.
Absolutely. From Los Angeles, born and bred, haven't left. So I followed that, Harvard Westlake to USC to real estate, which is a very common track here. Started working in real estate while I was at USC. Started in, multifamily brokerage at Marcus and Millichap just to, learn the language of real estate, just start learning, basic metrics and how to underwrite and how to talk the talk. So that was kind of my introduction into real estate. From there, went to work for a local developer. And it was basically just me and him. And it was a lot of just trial by fire and learning on the job and trying to just do as many deals as we could locally. And that was all apartment deals, kind of on the smaller side. Most of that portfolio was concentrated in Beverly Hills and West Hollywood, so mostly on the western side of LA. From there, I kind of took a step back, and I was still in college at this point, and I looked around and I was like, okay, I've done the brokerage side, I've done the acquisition side. The one thing missing is kind of the finance side of real estate. So in my senior year of college, I started applying to different debt shops, which one of them was at the time Latitude Management, which was a couple of years later acquired by LaSalle Investment Management. So I started there about my senior year, working as an analyst, moved up very quickly and was able to be a principal after my fourth year there. We were acquired in January of 2019 by LaSalle Investment Management. So we went from like a very small boutique type of debt fund, and then got absorbed into a much larger publicly traded company, which gave us a lot of the back end that we needed. It gave us a lot of the back office stuff that we needed and a lot of the capital raising capabilities that we didn't have as a small company. I think that was probably the main motivator for the acquisition. And then I left that company in the beginning of 2021 to start this new venture, which is kind of the blend of the equity side and the debt side, and just kind of putting it all into one.
Very cool. Before we get into that a little bit deeper and what you're looking for in terms of investment criteria there, I'm curious on the LaSalle, acquisition. What was that like when you had a big player come in? And did your volume just increase exponentially once you had those additional capital raising abilities? Or tell us about that.
So it was on the operations side. If you went into our office on December of 2018 and then you went back into the office in January of 2019, you wouldn't feel a difference. It's not like they came in and they put, the LaSalle sign up everywhere. It wasn't like that at all. They are very much about keeping the credit culture that we had built over that 20-year period. And they were getting into a business that they didn't know. And that's why they acquired us, is that they trusted us, and they kind of let you do what you do and they do what they do. And what they do is just professional capital raising. I mean, they're one of the biggest capital raising beasts in this industry. And that was kind of the impetus for why we were so motivated to partner up with them at that time. We were basically in the market every 3-4 years, raising a mortgage REIT, private mortgage REIT that was essentially always the same size. It was always in the $400 million to $500 million size in total equity. And I think as you start to look, and over a 20-year period, you're raising a series of these. At some point, you want to take it to the next level and grow. And so the LaSalle team is raising billions of dollars. They're constantly in the market raising different funds. They're constantly in front of, the pensions, the consultants, the sovereign wealths, the family offices. So they're have teams dedicated to market research and capital raising. And so for us, a company who was kind of, staying like this in terms of total assets under management, that was the next step in terms of growth.
Got it. So it gave you a lot of freedom just to focus more on originations and credit.
100%. They had no debt, American debt platform. They had a European debt platform. So my thought was they're probably bringing us in, and we were only doing value add bridge debt. My thought is that they're probably going to build that out into a couple different products, if I had to guess, because it is a very, the fund management business is incredibly scalable. You don't need to be hiring, 1 million people to be, launching another product. You need a couple originators, you need a couple underwriters. And as long as you're maintaining that credit culture, it should be pretty easy to scale.
Right. And while you were there, it sounds like you kind of discovered a niche or a gap in the market for this kind of smaller balance pref equity, and hence, breaking out on your own to start Base. Tell us about what you saw in the market that led you to that, and what it was like jumping out on your own.
Of course. So while I was at LaSalle, we were focused we had a very small box. We were focused exclusively on first mortgage, bridge debt between $5 to $35 million, all value add with a heavy concentration on multifamily. So, the box gets smaller. With that said, I think it's something like, I don't know the figure, but it is a massive amount of real estate that fits in that box, even though it seems so specific. And a lot of that is non-institutionally owned apartment buildings. And so there's a lot of opportunity for those non-institutionally held assets, the ones that are being idiosyncratically owned, to be acquired by these groups that are coming in with fresh money, with a fresh business plan, and able to transform the property. So that's kind of the business that I've been in for whatever it was, 8 years at that point. And what I was starting to see was that the debt markets were incredibly liquid for this type of capital. So, a sponsor finds a deal, call it 200 units in Atlanta, Georgia, and they're shopping the debt, and they'll have, 5, 6, 7, especially in the last couple of years where I feel like there's a new debt fund on the block every week. They'll, be getting term sheets from 5, 6 people. They put people against each other. The terms are getting more competitive. You're seeing leverage, pre-COVID, especially leverage was going, to unjustifiably high ratios. Rates were being compressed. So the debt side of that market is extremely liquid and very competitive. On the equity side of that market is still very inefficiently accessed. And the capital is not, there's no real reliable institutional player that's providing equity capital in that space, especially in the $1 to $5 million check size. So these sponsors are typically going to friends and family, and eventually they tap out on their friends and family. And while they have the capacity to be doing more deals and bigger deals, their capital is essentially tapped out. And so these are sponsors who have great access to deals, They just don't necessarily have the capital to be able to close on them, or they don't want to be constantly syndicating out the equity. So this is a tool for them to basically be able to retain all the ownership. They don't have to, give up all this ownership to the common equity. They don't have to bring in a big LP who's going to take most of your upside at the end of the day anyways, with most of your current cash flow. So this is kind of a debt-like product that's sitting in the equity position that's going to be cheaper than your common equity almost in every situation, and allows the sponsor the flexibility to perform their value-add business plan quickly, refi into some very cheap permanent debt, and we essentially disappear, and they get to retain 100% of the ownership themselves.
Right. That's a really, I think, well thought out place to be right now. And you said that the majority of the real estate in the United States falls into this kind of smaller balance bucket, and it's true. You get up into a plane and you look out the window, and 90% of that real estate down there is 20 million total capitalization and below.
Yep.
It's really easy to look at the big headlines and the big deals that go down, but the majority of the volume and just velocity is in that space, the smaller balance space. So,
well, that's the thing. And all these sponsors are looking for that type of capital. So that allows us to be very selective with which deals we're going to do. We can pick the best credits. We can demand pretty, I don't want to say draconian terms, but we're able to have a good amount of control, more than typical preferred equity, just because there's essentially no competition. There's nobody reliably doing this in the space. Right.
Very favorable demand drivers for your position. But any sponsors that come to you through me will get a good deal, right?
Yeah, of course. The cheapest pricing, highest level dollars.
Good. Cool. So that I think is a nice, just high level on what this product or investment criteria is, and maybe to illustrate it and give some context to our listeners, you could walk us through a recent deal, and with as much detail as you can share.
Definitely. So a good example is this is the flavor of the month, or flavor of the last 12 months, are these hotel to apartment conversions. So I think every hotel you see being sold has a section in their OM about conversion potential and whatnot. With that said, I think very, very, very few hotels actually fit the box for a conversion. I think a lot of them are just the dream being sold to the next person, and they're going to be unpleasantly surprised at how difficult it may be to do the conversion. But there are definitely some hotels that are having an efficient conversion into apartments. So this was an extended stay hotel. It already has the kitchens in every room. They're not micro units. These are good size units. We're talking, normal apartment size, 700 square feet, 1,000 square feet for a 2-bedroom. So it's not that whole micro unit, and you have a cafeteria on the bottom. This is highly amenitized. It's a highly amenitized extended stay hotel. And the conversion, and this is in Phoenix, so the conversion of this hotel is by right. There's no additional entitlements they need to get. There's nothing that they need to do as far as permitting for the conversion. Obviously, there's the permits to renovate them, but no additional. We're not taking any entitlement risk or any development risk on these deals. This was a sponsor that I knew pretty well. They've executed in that market twice before, so we got to see exactly what their product looked like. We got to see what the contractor looked like, exactly what they will be delivering into the market. And similarly to what I was saying before, these guys were tapped out on friends and family money. They still had strong balance sheets, but did they want to write, a $4 or $5 million equity check, just two guys? No. I mean, this was it it'd be easier for them to basically come to us, and we provide about 60% of that equity that they needed to close the deal, and they provided the rest. We were very flexible in the way that we collect our payments, and that's, I think, one of our biggest competitive advantages is how flexible we are in terms of payment. We have essentially 3 levers that we can control to get to our minimum yield. So one of them is a current pay component. There's an accrued component and an equity kicker. Obviously, those can be adjusted if somebody doesn't want us to participate in any profit. We can front load most of it on the current pay. And similarly, if there's not enough cash flow in the property to support a current pay, we can reduce that and back end most of it into in equity participation. So that deal was basically a 9% current pay. We took a reserve up front for the period that the hotel would be closed and not cash flowing. We accrued an extra 1%, and then we're taking about 15% of the total back end. But we also treat a refinance like a sale. So we'll be redeemed in, I think, before month 24. Once they finish their business plan, they'll find some cheaper perm debt, pay us off, and the deal is now 100% owned by them. Deal looks like we like these growth markets. We like these heavy value add business plans where there's a lot of value creation, and ones that are easily underwritable. They have deep competitive sets that you can underwrite to. The sponsor has some track record that we can look to in that exact market, and their balance sheets are pretty strong.
Very cool. Yeah, I think it makes a lot of sense, like you said, for a developer that has multiple projects going on, to use this type of product instead of diving into their own liquidity or going out and raising friends and family, which can get tapped out and can be a little bit hairy if you're under a tight closing deadline.
I'm sure you know this better than anyone. I mean, the deal terms are getting so competitive right now that seeing even a 30-day closing is not that common anymore. So when you're dealing with, on these mid-cap, smaller size deals that are called a $15 million, $20 million deal with a 20-day closing time, these people don't have huge offices with tons of analysts who can, and a capital markets guy and a marketing department and a research department. These are usually, a couple of people sitting in office finding deals, and they don't have the time to be underwriting the deal, focus on closing while capital raising at the same time. So this allows sponsors to just focus on the deal, focus on operations, focus on the budget and the business plan, and you do what you do, which is completing a business plan and operating the property, and don't worry about the capital raising at all. With that said, I know that there's been many capital providers who have said the same thing. And I think the big opportunity in this space is that none of them have been that reliable. So the main genesis of why we're doing this, the small balance preferred equity, is working on the debt side on these deals. I was seeing just horror stories of these smaller balance preferred equity guys who would, everyone would be pregnant in the deal and they'd come and retrade the sponsor a couple of days before closing, or they'd completely fall out of the deal a couple of days before closing and give some BS reason as to why it didn't work. My thought would probably be that the preferred equity fund wasn't capitalized correctly and didn't have the money on the day of closing, so probably made an excuse for it. But you just see these horror stories of people getting left at the altar, which creates a lot of opportunity for us. And if we can come out as being the one reliable, equity provider in this space, then I think we could do really well.
Yeah, and I think that leads to very programmatic partnerships where you are, kind of getting in a rhythm with the same groups, and they see the value in having you as part of the capital stack. Very cool. I'm kind of jumping back, but I want to go back to the extended stay hotel and talk about that as a trend because we're seeing a lot of that. I think your deal was great because the entitlement risk wasn't there, but I think that's a huge component that on a lot of those deals can be, I think, pretty risky. Are you seeing, were you seeing that maybe on the debt side where that was being mitigated on deals that did have entitlement risk, and how is that being done?
I'm getting, multiple packages a week right now for some hotel to apartment conversion. And I don't have to flip past the second page to know that that property will never be able to fit the box of a multifamily conversion. So I think a lot of people, and it's something to kind of be wary of, is a lot of people are getting sold on this idea of you could create so much value. The cap rates are so much lower in multifamily. The conversion's so easy, everyone's doing it. And that's really, really not the case. There are a few people that are doing it well. There are even more people that are just aggregating these properties, and I don't know what their plan is. I think they have the intention of converting them, but I think they're going to be surprised to see how difficult it is for, you think of like a normal hotel that, not extended stay, and these are 200 square foot units with no kitchen and no duct work and no plumbing that makes it for an efficient conversion. And those people have been sold on a dream that I think is going to be very hard to execute on. So to answer your question, how do you mitigate that risk? I'm not too sure that you can mitigate that risk unless you are essentially killing that deal. Like you could take massive reserves and you can try and do as much of the permitting as you can or very early on. I can't see ways that you can mitigate that risk entirely versus on the extended stay model. If you're getting it at a good basis in a market that has, there's a couple markets I've seen that have oversupply of hotel rooms and severe undersupply of multifamily. And you just look at it on a macro perspective, like Charlotte being one of them, Phoenix being another. And that's kind of a tell as to why the highest and best use would be multifamily. With that said, seeing, one of these conversions in suburban New Jersey, that's probably not the highest and best use for that property. And then that's kind of the where we are in I guess the cycle is that's the packages I'm seeing. It's like a 1970s build suburban Hampton Inn in New Jersey, and some guy is trying to sell somebody on the idea that this can be converted and should be converted to multifamily.
Got it. So you're looking at kind of the macro level, demographics and going, okay, these are the markets we want to focus on for that strategy because that's really where it makes sense. And then going further into it, if there is some sort of entitlement risk, you probably want to be working with an operator who's worked at the city there before and has a focus in that market, right?
Of course. I can't imagine a new sponsor coming into a city being that optimistic and getting all of the permitting if it's their first time doing it. That's not something that I'd ever put out money on.
Gotcha. On that note, let's jump to a question I always ask, and it's the war story question. Tell us about a deal that maybe didn't go as planned, or something. Just give us some drama.
I think the worst thing I saw, which they could still be in court right now, was a hotel deal I saw probably at this point. It was 2017. It was a hotel acquisition in Denton, Texas, where the guy had the property under contract. He'd been underwriting it. Again, everyone's fully pregnant in the deal. The guy had something like north of 250 grand hard in the deal just as a deposit. I don't even know how much he spent for the, to the architect and all the soft costs and whatnot. But uh, he had so much of his own money in the deal, and the guy's balance sheet uh, was good, but not good enough to be able to lose hundreds of thousands of dollars. Um, Closing day was probably a week away. They had their main LP equity partner drop out, and went completely unresponsive. As the lender, our incentive is, look, we're a partner in these deals. We were trying to help the sponsor get the deal closed. So we started reaching out to the equity partner. Again, completely unresponsive. The sponsor lost. Closing day came. He didn't have the money to close. Couldn't piece it together, and he lost all of his hard deposit and whatever money he had put into it. That was probably the hardest thing I have seen. And I mean, this is a couple of years ago, and I don't think I hadn't identified this preferred equity niche yet, but that goes to show that this has been an issue in the mid cap, small cap deal size for years now.
Yeah, and why do you think that is? Is it just that there's not as much accountability on your reputation risk because there's so many different players, or you know?
I think there's a few. I think there's a few reasons. I think most of the preferred equity, look, above 10 million and up, preferred equity is as easy to find as bridge debt. Just as there's another debt shop starting every week, there's another pref shop starting every week at the $10 million and up. And it's so competitive in that space. You can find preferred equity capital at 8%, 7% if you're going $10 million and up. When you're dealing with that dollar size on the allocator side, I think most of those allocators are finance people and not necessarily real estate people. So it's easier to, look at $100 million deal. You're just one piece in it, and be able to say that, here you go, $10 million, and that works. It's an institutional asset. It's core, being run by, Blackstone or some institution that has insane track record and a crazy balance sheet. That's not as much real estate as it is finance. So I think some of these people are a little scared to get into these deals because they don't know these deals. And with that said, I think you have to really know what you're putting money out on when you're dealing in the 1 to 5 space. You need to know who the sponsor is. Are they, honest, brave, and true, or are you at risk of being screwed? So the $1 to $5 million space is obviously less institutional. There's the real estate risk that doesn't necessarily exist in the $10 million and up space. But I think if you know the space well, you can mitigate those pretty easily, and still get a insane pricing premium. The cost of funds, the cost of our money is more than double what it would be for $10 million and up, but the risk is certainly not double. So you definitely get a yield premium, and a way outsized risk-adjusted return. I think the main reason why people aren't doing that is just institutionally sized deals are easier to underwrite. And I think those funds that are $10 million and up preferred equity checks probably have some back-end financing where they've levered up their balance sheet to be able to give a decent return, which again poses a list of its own risks. But it could be way more lucrative for the manager to be doing that on an absolute dollar basis.
Right. And there's also a human capital constraint when you get into those bigger funds too, right? They have a certain amount of money, to put out that they've been allocated. And if they're doing it in $5 million chunks, that's a lot of transaction inefficiency, whereas it's just a lot easier to put it out in bigger deals. So that's a challenge that you'll have to deal with. Like, what's your plan for dealing with the inefficiency of working in the smaller balance space?
Of course. I think that's the main concern that I hear about. what our intention was from the beginning was trying to make this as programmatic as possible and as boilerplate as possible. We have to obviously keep in mind that our sponsors are probably paying a large legal bill to the debt, already paying a fee for whoever packaged the debt for them. So this is additional deal costs to the sponsor on top of whatever rate that we're charging. So we have to be very mindful of that. We don't want to have the sponsors be paying, exorbitant legal costs and fees just for a $2 million check. So a lot of what we've done is partner up with good third parties, whether it's legal or whoever it may be, to make sure that we keep those costs very limited. Our underwriting methodology is the same as how we were doing it when I was working in the debt world, which again, I can underwrite deals pretty quickly in this space. I think I've been in this space for long enough where I can tell past deals that pass the sniff test. I will give them more time, and I would say about 80% of the deals that we see do not pass the sniff test originally and make for an easy rejection. But I think that's one of the things that is a misconception that kind of keeps people out of this space, which is good for us. So if anybody asks, tell them that it's a crazy amount of work for the $5 million deals. We'll keep them out of the space.
Well, it sounds like you got a handle on it. You've got the programmatic relationships and the quick sniff test, as a means to keep that under control.
I think the asset management is a way bigger undertaking than the originations. You have to make, because these are all value add deals, and our portfolio is going to be, there's going to be a lot of them in there, and they'll all be at different stages of renovations. So that's going to be the harder thing to monitor and manage, is going to be making sure that the business plans are being executed well, that everything is going to plan, even though things always come up, and that we're still keeping enough liquidity to address any issues if they were to arise. If we were to, let's say, come and take over a manager because there was some issue with the property or the deal or them, we have to still be able to be capitalized enough to finish the project. So that's I think the bigger concern when you get into this space is the asset management side.
Interesting. Well, let's kind of wrap this up on a high note. Tell us about your best deal in real estate. What's a big win?
Best deal in real estate. This is November of 2014. I was still working for, this was Latitude at the time. We were approached by two younger guys. I mean, they were probably 32, 33 at the time, just getting, kind of started in real estate. And they brought us a deal in Louisville, Kentucky, which I had never done a deal before there at that point. They brought us a deal there. It was a smaller deal. Their basis in the deal was, I think, below 30 a door, which if you told that to somebody now, it's kind of unheard of. You can't really find anything in this country that you'd want to buy for
How
under
many
30
units was it?
It was like 200, I think a little bit less than 200 units in Louisville. I mean, we were excited to do a deal in Louisville. They had showed us, I mean, they partnered up with the biggest manager who was also a contractor performing all the renovations. So they had a great relationship with them. They partnered up with them who they were actually going to be contributing to the equity, which made us feel a little bit better. And so that partnership gave us more comfort because that manager had case studies in the market right down the street. They had all the comps. They owned or managed most of the comps. So it mitigated some of the risks. But I'll tell you, we went to that property. It looked like, I mean, we used to call it in our office Chernobyl. because you showed up and there was like an abandoned playground there, and half the units were boarded up, and there was like water damage and fire, everything you can name the property they had. It was on like a failed boiler and chiller system. Disaster. And we got to the property, and me and my managing director looked at each other just like, what did we get ourselves into? Why are we here right now? With that said, we toured the property with the two guys, with the management company. They walked us through the entire property. They knew every nook and cranny of this deal. They knew where every dollar needed to be spent. They spent the day with us. They took us to their other properties. They showed us what those looked like before, what they looked like after. These sponsors, at that time didn't have 2 shekels to rub together. So we brought one of their partners on to sign on the carve-outs as well. These guys executed the business plan inside of 18 months. This property was something, it went from Chernobyl to something that I would have lived in happily at the time. And they sold that thing for way over 100 a door a couple years ago. So that was probably the best deal that I had seen come full circle. We ended up doing 15 deals with that sponsor. They ended up doing over $200 million of deals in that 6 or 7 year span. So good for us, good for them. Kind of started their career, and now they're extremely successful.
That's a great one. I love hearing stories about young sponsors getting their start, and it's hard because it's kind of a chicken or the egg thing, right? You want to see some track record and the ability to execute, and I think it sounds like on that deal, what got you comfortable was having them partnered with a manager that they probably gave away a lot of the pie to that group. And then knowing that deal inside and out when you went to go tour it. Was there anything else that was able to kind of get you comfortable, has been able to get you comfortable with younger sponsors or people that lack track record?
Yeah, I think as a stronger balance sheet to be able to sign on the carve-outs, that eliminates a lot of the risk for a lender or a capital provider like me. Obviously, that is a little bit easier said than done, but it's hard for somebody to underwrite a new sponsor without seeing a full case study that's gone through acquisition all the way through disposition if there's no strong balance sheet behind it. So I think that's just one of the sad realities of where we are in the market now. And there's been so much consolidation and so much competition in the last 5 years in real estate that it's becoming increasingly harder for people to get their start. Look, I think my intention, going from the brokerage to acquisitions to finance, did I think that I would be in finance for, whatever it is, 10, 7, 8 years now? Probably not. I thought that I would go into a debt shop and learn everything in a year or two. And then, like every kid's real estate dream is go start buying properties and developing and then get really, really rich really, really quickly. That was not the reality. I think finance was a great fit for me, and never did I think that would be true. But that's another way of how, I saw my path to the end goal, which is, I think all of our end goal is having a large portfolio and making a good amount of money and making a name for ourselves in this industry. So I went the route of capital allocation rather than deal acquisitions and operations, because that world has gotten so competitive and asset values are so high that it's very hard, at least in my messed up lender brain, to be able to justify paying those prices and doing those taking on those risks, especially in the market right now. I think it's kind of prudent to be lower in the stack.
Yeah, absolutely. Well, excited to see you come into this space and start up your own shop. And if there are sponsors out there that want to develop a relationship and want to start sending deals to you, what's the best way for them to do that and present their deal and get in touch?
Then send them to you, and then you send them to me, and we'll use you as our middleman. I think that's probably the best way to do it. Obviously, it's a much easier for a lender or a capital allocator to always have somebody like you in the process. Just being able to control the flow of information and make sure everything's getting done and everything's being delivered. With that said, we still get deals from sponsor directly, but it's always easier to have somebody like you that's working, making sure that both sides are working and working efficiently.
Well, I appreciate the plug, and thanks for keeping us in business here.
Yeah, the clear market plug right there. I wasn't paid to say that.
Well, maybe we should start. Cool. Hey, Eli, thanks again for joining us. Pleasure, and looking forward to getting the next one across the finish line with you.
Likewise. Thanks for having me.